Jay.
Hey there. How you
Hey,
doing?
not bad yourself.
All right, long time no see.
So, so yeah, Jay. The reason I asked you to chat really quickly was, I've been doing some thinking about, the financial repercussions of the shutdown on, contracts and deals and lending in general. So that's why I reached out. I figured I would get your perspective, and just a couple thoughts on some of this stuff. We could start with the CARES Act and forbearance. Like a lot of people got really excited when they heard that part of the program coming out. The ability to push out their mortgage a bit.
Yeah, I mean that's all through the servicer. So yeah, those are all. It's pretty interesting because we don't even know how it's going to show up on someone's credit report going forward. So it's going to, could possibly have a drastic impact, maybe inversely, on someone's credit report if we're not able to show like a 12-month history of them making timely payments. It's going to really affect mortgage refis, and then possible if people are looking to maybe purchase, in the fall. So that's where I see kind of this forbearance coming into play, and also as you've kind of seen from some of our notes there, is that money just gets tacked on, and is someone going to be able to make that larger payment over a 6-month period once they start making those repayments? Are we just kind of pushing the can down the road to not a very good situation? So we're really advocating for, if people can make the payment, make it now, so they don't run into an issue down the road of just not being able to make that payment, that larger payment work.
Right. Now, are you seeing a lot of lenders requiring a lump sum to be paid back in a specific point in time? Or are they amortizing these payments across the rest of the mortgage life, or how is that looking?
Usually it's going to be servicer to servicer. So,
Right.
Wells Fargo could have a different rule than Chase, than Wells, than, even, the local bank may have the different payment period. But again, what I'm seeing most happen is like, okay, if people are taking the 3 months off, and it's $2,000, so now all of a sudden they've got $6,000 that they're behind on. Well, interest is still accruing on their balance. And what's going to happen is that what I'm seeing most is that they're going to say, okay, you've got the $6,000 that you owe us now. We're going to divide that over, whether it's a 6-month period or a 12-month period. It's still going to be a significant raise. It's not going to be over the life of the loan. Typically, it's going to be, I would say, less than a 12-month payback. But again, it's going to be each servicer. And those are the questions that the consumer really needs to ask before they say, okay, I want to stop the payments for now and go into the forbearance process.
Right. And that's really the reason I was asking that question in particular, because there seems to be, in most of the chatter, if you will, about it, the number one myth that I've heard is that it's amortized across the rest of the life of the loan. So if you have 28 years left on your mortgage, it's amortized out across those 28 years, but that may not be the case.
Yeah, it's going to be, I think that the way I've described it is what you're going to see most servicers doing, because they need to become whole, meaning that Fannie is still asking these servicers. So imagine, like I said, we'll use the example of, I said $2,000. I didn't make my April 1st payment of $2,000. Well, I paid my mortgage to ABC Servicing Company. They still need to send my $2,000 payment off to the investor, Fannie Mae, Freddie Mac, whoever it is, say FHA. Well, that servicer needs to make themselves whole back at some point. So I don't foresee many of them stretching it out over a 30-year period, because, imagine that they've had to they've had to cover my $2,000, but let's multiply this over hundreds of people, that company might be servicing that have asked for forbearance. Now they're sending, $2 million worth of payments out to Fannie and Freddie, but they haven't gotten it in from their consumers. So they're going to need to get that money back, and they're going to want it back sooner than amortizing it over whatever is left over the life of the loan, I would say.
Right. Yeah, that makes a lot of sense. Okay, cool. And the second question I had, I know I might be asking you to pull out a little bit of a crystal ball, so I'll
That's
try
okay.
and keep it as broad as possible. But we're seeing, skyrocketing unemployment, specifically forbearance is in like temporary unemployment. And so, beyond requiring a borrower to push out the closing date to the point where they can get back to work, what does that look like? What are the repercussions of a temporary lapse in employment, or furlough, looking like on your end? How does that work?
Yeah, so if people are looking to try to close on their mortgage, we need to make sure that whatever we looked at when we went under contract, and have said, okay, this person makes X amount a month, that needs to stay true from the start of the application all the way through to the verification of employment, where industry standard is a minimum of 10 days prior to the closing that a verbal verification of employment to an HR person from the processor calls up and asks, are they still working the same amount of hours that we verified at the beginning of the process? Have there been any changes? If there's yes and negative connotations to any of those questions, it could trigger that we have to do another verification of what their income is to see if they still qualify for the mortgage at that point. So again, it's a big pillar. If we have anything that's knocked off of that, it could jeopardize someone being able to close, and they'll be out there, their appraisal fee, unless someone is at least able to work with them and maybe extend their contract till they get back to say 40 hours, because they were now reduced down to only 20 hours a week for work. So I've really noticed that buyers agents and sellers agents are showing a little bit more compassion, and some sellers are as well, on understanding that we're going to see some interesting pieces that are coming up. I wish I could be a little bit more certain on my answers, but all I can do right now is kind of go with what I have right now, because we're seeing changes every day to how the guidelines are being updated.
Right. If not, every couple hours, like our governor Phil Scott just announced that the lockdown is lasting for just over another month. What, a couple hours ago?
Yeah.
Which was to a certain extent not that big of a surprise, but still, when things are changing this rapidly, everyone's sort of scrambling just to kind of make sense of it, and as we go along. But I wanted to run a hypothetical past you.
Yes.
Say I was applying for a mortgage and I obtained a pre-approval, and I've got a house under contract, and I'm cut back in hours, or furloughed for a couple weeks or a couple months. Does that mean that we've got the tools to be able to extend the contract? The seller and I have agreed to extend the contract for 90 days or whatever it is. If you do that, does that trigger, do I have to go through the entire loan application process all over again?
Not if we're staying with the same home. As long as that we're still under the same contract, we're still able to make those adjustments. Just because we filled out an application at the beginning, that's our initial application. Nothing is set in stone until we go to closing and we sign everything. So we have that fluidity to move it around and see changes, because everything is fluid. Things are changing on the credit report. Things are changing in the bank statement from when we first, started, 2 weeks ago to where we are now. So what we can do is we can lock in the underwriting guidelines from when we got the application 2 weeks ago, let's say. But we're going to want to look through and just it's just communication that the lender's having with the borrower and with the HR team to make sure that we want to make sure that when we put someone into the home, we're setting them up for success from payment one. And that's what's most important about just being a good lender. It's not about the transaction. It's about making sure that they can make those payments, and be a responsible homeowner.
Right, and I think I'm really glad you made that point, because I think that gets lost on people a lot of times, especially with some of the headlines that are coming out these days.
Yeah,
And it's not about not closing a transaction; it's about making sure that you can set that homeowner up for success. As you said, I think that's really key. Yeah.
definitely.
Great. Those are the questions I had for you. Do you have any other observations you'd like to share at this time?
I mean, I think that what a lot of people are looking at is what happened in 2008 compared to what's happening now. And I think that our industry is going to be the piece that's going to help kind of save the economy if we can keep the housing market strong. I mean, I see that the differences between now and 2008 is that we have higher mortgage standards, which is a good thing, because back then they were more loose, and I think that people were getting into problems. I think that we have stable pricing right now. We don't have a surplus of homes like we did back then. I would say that we have a shortages of homes. So I think that we're not going to see values drop in our areas, because I just see that there's so many people that are looking to stay in housing right now. What's nice is that I think more people have kept equity in their homes on people that already own properties. They aren't cashing out as much as they were back then. So, and also people have been a little bit more, I would say, cognizant of their monthly expenses on their homes. Right now, the median income, they're spending around 15% of their income towards housing, where back in 2008, people were spending over 26% of their income towards housing. So I think we're definitely in a better equity position for a lot of our borrowers. And I think that we're going to work through this, and we've always done a good job here in Vermont of making sure that we haven't done anything too extreme like some of the other larger cities, or throughout the U.S., where we see high peaks and low valleys. It's pretty stable.
Just a point of clarification: those numbers you tossed out, were those national or Vermont?
Yeah, these were national numbers that I had here. I think I share with you a snapshot of Lamoille County.
I think you did. I don't have it in front of me, but
okay.
Basically we pretty much, even though we're kind of a micro market, and people love to think of Vermont as this like green little pasture that's completely separate from the rest of the continental states, but we do pretty much mirror national trends, to an extent, obviously.
Yeah.
But I'm glad you brought up the correlation between now and the housing crisis we saw in 2008, and I really cringe when people try and make a comparison there, because
apples and oranges. Yeah,
exactly. It's I mean, the causation is like couldn't be more different, basic. Housing is like kind of a basic human need. So, which is why I included a graph below on the correlation between unemployment and housing. And there's not a direct correlation there. So I think that's a really important decision to make. We're in a totally different place now than we were back then.
Yeah, I mean, I think that we've got actually even lower rates than what we had at the end of the crisis period of time. So if people are looking to get into mortgages, it's like I said earlier, the affordability index is very, very easy right now.
Yeah. And along those same lines, do you foresee rates decreasing over the next 6 months?
I think that if we see this high unemployment rate still continue to trend up, the Fed still has a bunch of buying power left for mortgage-backed securities. So I feel that we've seen over the last couple weeks, from when we had some big volatility around St. Patrick's Day, we've seen rates kind of start to creep back down. So I feel confident that we should see rates still improve throughout the rest of 2020 here.
All right, Jay. Well, I appreciate your time.
All right. We'll connect soon.
All right. Have a good one.
All the best. Bye.